Joining us now is Lazard CEO Peter Orszag. Peter, welcome. We were hearing that there were green shoots and things were starting to happen, and we've seen some evidence of deals, but that was before, obviously, the events of October 7th, and the world feels like it's changed. Have you seen a noticeable impact on deal making?
Well, first, I think, again, we need to really be clear about the process of having the M&A market come back, because it will, first of all, happen in fits and starts. And second of all, it doesn't happen overnight. I think we've talked about before, the first thing is client dialogue, the tenor of that changing, and then you have announcements picking up, and then you have revenue. So some people are looking for the immediate revenue, and it just takes a while for that to show up, just given the way the process works. Now, with regard to the events in the Middle East and elsewhere, there is a lot of geopolitical risk out there in the world. I wouldn't say that it's having a massive effect yet on most of the client dialogues that we're having, but obviously if it were to expand and spread, that would become a much bigger concern. And more broadly, it's impossible to make a business decision today without assessing the geopolitical trends.
There's also the rising rates issue, and we saw this another leg up in rates in the last few weeks. It's come down over the last week or so. Hard to tell, but can you really see any pickup in activity unless we know that rates have stabilized?
Well, I think it is important for rates to stabilize. The level also matters, but probably less than the degree of stability. And so, yes, there's been some volatility in the Treasury market. I think this highlights a few things. Obviously, our fiscal outlook is worse with higher rates than with lower rates. I think it also raises some questions. It had been kind of the new in thing to focus on a new metric, net interest as a share of the economy, as an indicator of whether we're on a stable path or not. And when interest rates can move as quickly as they have, it illustrates that that metric is probably not a reliable indicator of whether we have to make some adjustments or not. It's also unfortunate, by the way, that we didn't lengthen the maturity of our Treasury debt when we could. This is something that Bob Rubin and Joe Stiglitz and I called for in 2021 when the 10-year was at 1% instead of 4.5%.
Of course, and then Druckenmiller added to that debate in the last few days. Yellen tried to push back, Peter, and argue that duration portfolios, the longest it's been in decades. But how much incoming do you think she really deserves?
I'm sorry, you broke up. I didn't hear the last part of your question.
I was just curious how much criticism you think Yellen truly deserves, and whether Mnuchin needs to share some of that, or how much of this is worth going back and thinking about.
I don't think finger pointing is constructive, but I do think that we've got an opportunity now to re-engage in the debate over the fiscal trajectory, which is going to obviously influence those long rates. The past is the past.
Do you think that is having an impact on long rates here? I mean, clearly the market was encouraged by the refunding announcement last week, that it was less than expected. But do you think this is going to be an issue, a perpetual issue that will keep real rates elevated for a while?
I think there is a substantial risk of that. If you look at the pressures that the budget will be under, not only the demographic trends that we already knew, but also probably the need for additional defense spending, given the geopolitical risk that we were talking about a moment ago, and also the necessary spending associated with the energy transition. You can see upward pressure on government spending over the next, the foreseeable future, and frankly, probably an inadequate revenue base to match that. So there will be, plenty of supply coming onto the Treasury market, which does tend to raise rates.